Hi, welcome to the Leeb Group. Today is Wednesday, September 3rd. I'm Greg Dorsey. More good news is no news today in the stock markets. We had the ISM non-manufacturing index come out higher than expected at 48.4%, which is still below the 50% number that typically marks an expansion, but it was above the 46.4% reading in July. That follows Tuesday's better than expected ISM manufacturing index, which showed that sector of the economy is expanding. A few months ago, these kinds of positive surprises would have sent stocks soaring. These days, however, they're largely being ignored. This leaves us wondering what will push stocks higher. Shares did close higher on the day thanks to a late day rally, not because of this earlier data that came out this morning. But again, we had the same pattern of light volume up days, heavy volume down days that has persisted. So we wouldn't read too much into the late day move. Also out today in the economic picture, we had weekly jobless claims, which ticked up and remained quite high at 570,000. Retail sales data that has been rolling in has been certainly less than impressive. Most of the companies have missed their mark, reinforcing our view that the economy isn't out of recession yet. Money supply growth figures also came out. The growth there is non-existent. And it's really hard to imagine the economy gaining a head of steam until this does turn. Tomorrow we have unemployment figures coming out, and that could roil the market. The street is expecting a 9.5% rate with a 0.1% increase. Mass layoffs have slacked off in recent weeks, reducing the odds of a real big surprise. But nevertheless, a bigger print is still quite possible. Now, the action in the credit markets has us more than a bit worried. I would refer you to a New York Times article today titled Ominous Signals from Bonds Data. Boy, that was a mouthful. The article cites various plausible reasons for yields declining, with the conclusion that whatever the cause, the outcome isn't likely to be good. We have to concur. In the commodities pits today, things were mostly down, with one notable exception, gold, which clocked in a second day of big gains. The yellow metal closed, rallied towards 1,000 before backing off in after hours. One possible impetus for the buying, China announced that it's going to purchase $50 billion in notes from the IMF. These notes will be denominated in special drawing rights. Many people see that as a step towards, a step away from the dollar and towards the creation of a new reserve currency. That would be bad for the buck and, of course, good for gold. This reinforces our view of the importance of a focus on capital preservation right now. So, again, the mantra we've had remains the same. Get yourself some gold, get yourself some zero-coupon bonds, and don't be in any hurry to buy stocks here. Enough for today. Thanks for stopping by.